Welcome to the College of Wealth podcast, the ultimate financial guide to help you understand your financial stresses and how you can build from it. Your lessons won't be in class, and your projects can either save you or earn you money. We host episodes 2 times a week on Tuesdays and Thursdays to help you reach your financial freedom. Now let's get started with your hosts, Owen, Paradis, and William Goulet.
Hello, everyone. Hello, everyone. Hello. So much everyone here. We like it. My name is Owen Paradis. I'm here with my co-host, William Goulet. We're proud to present to you the College of Wealth podcast.
Podcast.
Yes, this is a College of Wealth podcast. This is a financial podcast that teaches you the latest and greatest information about money. Because at the end of the day, this is a crazy money-making world.
Crazy in multiple senses. Full disclaimer, I do have a cold, so that's a little bit crazy. But despite it all, it's still a money-making world.
Very well said. True to that. True to your will. True to your word, Will.
That's right.
And because we do like to say it's a financial podcast, we also like to indicate that this podcast is for entertainment purposes only.
Okay,
really
so you have
what?
Notes on that.
What? Oh, okay.
I have notes on that and our intro. So we do say that it's for entertainment purposes only, but
yes,
I think the only part sort of reduces our projected value of the information that we do.
Okay.
I think we should start including that as part of our pitch.
All
right. I was thinking we should call it something like Tainment Info.
I'm going to end the podcast right here. I'm going to end it right here.
Or I have another one. Maybe you'll like that one better. Infotainment. What do you think?
You're lucky. I'm looking at you smile here. I'm like, don't do this. Don't do this.
You were, if eyes could beg, you had those. Don't do it, Will. Well, here we are. I said it again. Tainment Info.
But let's disregard that complete garbage and nonsense that Will just said.
Okay.
Here at the College of Wealth podcast, we do really enjoy, absolutely love with passion, undeniable passion,
no
to
exception,
call this infotainment.
Oh, yeah, I'm glad you liked my second suggestion.
And because of that, we do like to go and say that Will and myself are not financial advisors.
No, certainly not me anyway, so.
I'm not either. But we studied business. We both have a bachelor's degree in business. I work finances. Will works marketing. And it just kind of sort of validates the fact that we do, that we're passionate about this kind of stuff.
Validates is the right word, As I like to say, this little disclaimer that we do, it means that our interest is valid, but not just in any way. Valid in the Gen Z way. Imagine the check mark, the check mark emoji beside it.
Exactly.
It's valid.
For sure. And I agree with that. And there's actually 2 other reasons why we do this podcast as well. Not only are we passionate about it, or do we find that we have a love for podcasting, we also have a love for 2 other things.
Yes.
And what are those things, Will?
Me. Let me say it.
Literally the only person there.
Yeah.
Anyone else want to answer?
Yeah. 2 reasons, of course.
You janitor in the back.
Please let me answer. Number 1, we love to make money. Right? Because, we're young. We aspire to have financial independence in the future.
For sure.
And that's what we do.
Yes.
Reason number 2, we don't like it when people take money away from us. So we're trying to find ways of how we can keep it. In other words, we love to save money.
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 So I agree with that, Will. So it's true that we both like to make money and save money, and that does really well with today's episode. And that's actually, it's going to be a real estate episode, and it's going to be a cool one. But without going into that too much, we do have to go and talk about our socials. If you haven't done so, give us a 5-star review on Apple or on Spotify. It would really help us out here. Helps with the algorithm, honestly. I don't know how the heck the algorithm works. It just does. It's like a little hamster on a wheel, and every time every time you give a 5-star review, the hamster gets a little carrot, and it keeps throwing us up to the algorithm. So cool stuff. But if you haven't done so, also check us out on YouTube. Give a subscribe, give us a like. Go and check us out on TikTok. Go and check us out on Instagram at College of Wealth Podcast. So many different platforms to go and see our program or what we have to offer. So without further ado, we got to talk about episode 129, how to finance real estate without a mortgage.
Whoa, creative financing.
Creative financing.
Wonderful. I'm in.
Yes. So I'm actually excited about this one, more specifically on our stats and fun facts today.
Okay. No, you know what? Those really are the way to go. We could do an episode on stats and fun facts and just the back and forth experiences are so fun.
Well, that's it. And I'm so excited about it because I got really, really good stuff. And after this, we got 4 different ways that you can finance without a mortgage.
You know, I've seen some local creators actually near our area that are actually starting to build themselves a name as well for creative financing, just in a nearby city.
Oh, really?
Yeah. So
that is really cool.
Well, Mel and Dave, actually. That's how they go by.
I've never heard that name, actually.
Well, that's one of their big things is creative financing, so I look forward to hearing more about it.
Oh, Mel and Dave. Okay,
yeah.
Yes, I've heard of them. Yes.
Yeah, well,
Very
they're
cool.
local, and they've found lots of success using creative financing.
Yes. Really, really cool. So now that we're talking about financing here, we got to talk about our first stat here.
Statman!
Of course.
Of course.
And the way we're going to be doing this is our first one. I want you to guess, Will. These stats are from the CMHC. So so you obviously know what the CMHC is there for mortgages. So what is the average mortgage in Canada?
Oh, the dollar amount?
Yes.
Let's go for $450,000.
Oh, sorry. Monthly payment. Average mortgage payment.
Yeah.
You know what?
I stick by my answer. No, I'm kidding.
No, okay, but that was actually our second stat, average mortgage loan, and you say 450?
Yeah.
Okay, well, it's actually 486,000 in Ontario, just under $375,000 in Canada.
Oh, really? So Ontario's actually got a high average.
Well, yeah, Ontario and BC have higher home prices.
Yeah, but I would imagine that up north the average would have still brought it down, you know.
Well, I mean, for every home there is in Northern Ontario, there's 5 of them in Toronto and GTA.
Duh. Yeah, you're right.
So it's just, 486,000. Of course, that doesn't take into account all the down payment that you have. So that's exactly why it's the average mortgage is not reflective of the average purchasing price of a home.
Yeah. Okay.
Our second stat is the average monthly payment for a mortgage.
Okay. Monthly payment, it's bound to be something like $1,400 a month.
$1,758.
Oh my!
Yep.
Where are Canadians getting this money from, man? Please.
In the USA, it is $1,487 a month.
Oh, so okay. I was just stating the U.S. stuff. That's why. Okay.
By the way, for the mortgage loan for the United States is $411,000.
You'd think that it'd be higher. Mind you, they have a lot more preferential ways of having a lower down payment.
There's a bigger diversity of homes and more homes over there with different prices compared to Canada.
Yeah, interesting.
So this is going to be our fun facts now. This is going to be really, really cool. I'm excited to talk about these ones here.
Mm-hmm.
And I guess this one is going to be something you're going to be more listening to on
I'm all ears.
So, do you know what a curbstoner is, Will?
I have an idea, but I think I'd rather let you say it because I don't think I'm on the right track.
It has nothing about curb stomping.
Oh, okay, good.
So curb stoners were actually the first form of salespeople for real estate.
Okay.
And the way they would do it in the early 1900s was to go and park themselves in front of a house, put their sign up, a house that's for sale, obviously, and stay there from 9 a.m. to 9 p.m. to go and do open inspections of a home with potential buyers.
And they would represent the house?
Yes. Well, no, they wouldn't represent. They wouldn't represent a house. They would be towards the buyer's side.
Whoa.
Yeah. So they would stay at a home, not in the home, but stay whether it be on the side of the street or in a car from 9 a.m. to 9 p.m. just to try and secure a deal. So it was very common to see dozens and dozens of signs of for sale signs on a property from different. Yeah, because they're all fighting for a property.
Oh my goodness, that is so weird.
And the downside of it was, while you're all fighting for one property and you're only working on one property to sell.
Yeah, and your time isn't spread out. It's
no,
all focused on one area.
Versus today, real estate agents can cover many houses at once for a buyer.
Yeah.
And for a seller.
With phone calls and laptops now, they're able to scale up their business a lot more.
Exactly.
Than the average curbstoner.
Yeah. Our second fun fact is about open houses.
Okay.
Do you know why open houses are only on Sundays? Or mainly on Sundays?
Does it have anything to do with church and people going out of the house for church?
Somewhat, yes.
Oh, all right.
Many states in U.S. actually forbid transactions of that kind on Sundays because of religious purposes. So open houses were put in place so people can go and view houses without actually purchasing them on the Sunday. So the paperwork would be done on the Monday through the Friday with no issues of transaction in the way.
That is so cool.
I saw that and I was like, that is really, really cool.
So even when you're not purchasing, you're still scouting out for the next purchase anyway.
Right after church.
Yeah, right after church. Yeah, you maybe grab a quick brunch, or can you even get brunch? I don't know.
Of course, you get brunch right after church there. Like you have brunch at church. Do you not know this, Will?
No, I guess I don't.
Yeah, like I mean, there's often little brunch or whatever, depending on the church. There'd be little things like little meals or breakfast, toast, bagels. Depending on the church, sometimes there's like full-on brunch as well.
My goodness. I don't think we went to the same church. When I was a kid, it was just you go to church and then you're like, let's go to a restaurant, and grab some brunch.
Last but not least, though, this is our last one. Mm-hmm. Did you want to take a wild guess on what year the first recorded instance of using incentives to buy a home came in?
Okay. An incentive to buy a home, I'm going to say 1932.
Very good guess, but add an extra 20 years to that.
52.
1952.
Really? Okay.
Yeah. So the first instance recorded of using incentives to buy a house was by the Howdy Howards. Yeah, the Howdy Howards Holiday Homes.
That is such a cool name for a company.
Howdy Howards Holiday Homes. And they offered free Coca-Cola for anyone who came to the open house.
Wow. That is so cool.
And just to throw in a little bit of an extra, just a minor one, whoever purchased the house got a free Cadillac.
Whoa! Oh my goodness. Man, Howdy Howard. That's so cool.
They don't mess around.
That's good customer service, man. And I love customer service. If there's one thing about me that's consistent, it's my love for good customer service. If I had a Howdy Howard today, man, I'd be a customer, I bet.
I'm sure they probably still offer free beverages now because they're known for something like that.
Well, now I'm curious if they're even in operation, But that does bring me to the quote of the day, Owen.
Okay.
Which you'll remember this week is Steve Jobs.
Okay. Yes.
And this one's simple. It's a 2-sentence, 4-word quote where he says, "Stay hungry, stay foolish." And Howdy Howard is a perfect example of what staying hungry is like. It's about that hustle. It's about working, adding little extras, working hard to get your customer in the door and out the door with a purchase, you know? And the stay foolish part, you know what? You and me, we're young. And to be foolish is to be willing to say that you need to learn more. And by learning more, that's how you keep expanding what
you make
you're
mistakes and you learn more.
Well, yeah, but they don't always have to be your own.
No,
you know?
That's true. That's a good point.
Which is why a lot of people have mentors, right? Avoid making all the stupid mistakes, so that they could learn. But that's what Steve Jobs says: is stay hungry, stay foolish, keep learning, keep hustling, keep watching, keep subscribing.
Easy,
but that's
breezy,
Steve Jobs.
Beautiful.
Yeah, cover girl.
So now that we got our fun facts and stats put into place here, I thought that was really fun to cover. We got to go and talk about our first way of funding, or our first way of financing in real estate without actually owning a mortgage, but having a mortgage.
Right. All right.
And the first way is the rent-to-own program.
Oh yes. Okay.
And the rent-to-own program is something, it's not something new, but it's actually something that's, it's basically a form of agreement between the property owner itself and the potential buyer. And usually it's more often than not, typically like the landlord and the renter, I should say, who are doing it. However, you have options where people were able to go and get it through means of real estate property investing groups or anything like that. Sure.
And maybe there is an opportunity to sublet as you're doing a rent-to-own scenario.
Yeah, that's an option too. That's a really good way of looking at it for sure. And a lot of people tend to do it organically through connections like that. But like I said, you can go and reach out to different potential homeowners who are interested in doing this program. I've actually seen it a few times myself.
Yeah.
Usually it's done with people you have a relationship with. Typically, but again, you can do it with anyone in general. But
now, I'd like to discuss one of the advantages to the person who's doing rent, the landlord.
Okay.
Do you have it? Do you have it mentioned as one of the points?
I have some points, but
tell you what, I'll let you go first, and then I'll hop in.
Okay. So before we talk about some pros and cons of this kind of stuff, you have to go and consider the agreement itself. Mm-hmm. It is so imperative to do that. You need to go and read the fine print, because what exactly is it that? So at what point do you actually purchase the home? When do you actually, like, how long are you doing the agreement? Like, how much is going towards the payment itself? Like, you don't, if there's no specific amount and the home is worth $250,000 and then they go and tell you you're going to rent to own until you pay off $500,000, is that something you really want to do?
Yeah. Is that fair to you?
Is that fair to you at all? Like, maybe some people are okay with that. But it's really important to have a written consent agreement signed off, so you're able to hold true to it as well.
Yeah.
And the last thing before we talk about the pros and cons is you need to also look at the terms. And it's very common to see options to have like a buy-in, as we call it, or to lock in with 1% down or 5% down to begin with.
Okay. So just a little upfront commitment.
Correct. Yes.
Interesting. Yeah.
So tell me, Will, what are some of the advantages?
Okay. For the landlord, if this person happens to default on their payment, and obviously you set some clauses together, you get along with this, but a lot of times you just regain possession, and it's back to business as usual.
Yes. Actually, it's true.
And it depends if your agreement says that you own a percentage and that you keep buying a percentage. But if it's just an accumulation and there's a transaction date and that date hasn't happened, and they default, you still collected all the rent, and you say, sorry, the contract's null and void now because you're not living up to your end of the deal.
Well, that's on the buyer side, where you have to be very, very vigilant, and you can't be missing things here, because that's exactly it. You miss a payment, and that could actually null or void the contract itself, and you just lost the entire thing. But if you're really good on... Yes?
Yeah, something similar is rumored to happen in Dragon's Den. Whenever there's a deal structured with a loan, if they default on it, then they get a certain lien on the business, and they're able to actually sort of take over the business.
I did not know that.
So this is all hearsay, rumors, you know.
Yeah.
But apparently, that's something that happens when there's a loan structured into the deal.
That's wild. Yeah. I would not have thought that, but it's business after all.
Mm-hmm, mm-hmm.
The other side to have into consideration when you are doing the rent-to-own program is typically, like, the purchasing price is agreed up front. So if it does increase in value, well, that's not really something you're not going to have to pay more over the years. So let's say it takes 5 years to pay off. If a pandemic happens and the price of the home doubles over time, well, your home price is not going to be changing.
You're locked in. You made a deal.
Same thing goes for if it does go down in price too.
Yeah. You're locked in. You made a deal.
And there's actually two different types of purchasing you can do. You can do a lease option, and that's where part of the rent goes to paying off. And this is where you're not entirely sure if you want to actually purchase the home itself.
Yeah.
And then the lease purchase is that you have to purchase the home. So no matter the case, you made the agreement, it's done deal, and you have to make the payments.
Yeah, and you got to be careful. Is that really something you want to commit to?
Yes, exactly. Do you actually really love this home? If so, great. Then maybe doing a lease purchase is the right thing to do. But if not, a lease option could be something that you should be looking at.
And if it's not in your name and you're tied into payments, how are you going to replace that income? You know, you can't just sell it if it's not in your name yet. You don't own the title. Not at all. No. So it's tricky, very tricky.
So that's basically, talking about tricky. It's really important, like I was saying, read the fine print with this kind of stuff, because you don't want to be screwed over. You want to know what type of lease it is, what type of financing, and it's just overall really important to do your due diligence. You can't just hop into this all willy-nilly.
It's true, and that's why, there are courses being offered on it. I imagine there's even creative financing lawyers that are out there to help out,
I'm sure. So our second form of financing that you could do for real estate without a mortgage is the seller to owner financing.
Seller to owner. Okay.
Seller or owner financing.
Okay. Tell me more.
Instead of taking out a loan or something like that, you're basically paying off. You're paying off. So it's similar to rent to own in that sense, but basically where the seller to owner financing is, it's done where if the owner doesn't need the cash right away, and getting a loan for you is difficult as a buyer, you can go and do the financing through them. And
so the person who's selling will actually finance the purchase.
Yes, correct.
Interesting.
Yes, exactly. So it's very similar in a rent-to-own program in that way. However, there's a few differences. Like, it's very common to have like a balloon payment several years later, or at the end of your payment term. For anyone who doesn't know, a balloon payment is a large payment at the end.
Okay.
So you have to make just a large payment there.
Yeah. So and how would that be? Is that like an interest, or is it like a lump sum payment at the
lump sum
end?
Payment.
Interesting. Okay.
Yeah, and of course it's negotiated between the seller and the buyer of in this case here.
Yeah.
There's a lot of perks to this, obviously. The first thing is you can save a lot on closing costs, and you can get a smaller down payment because of it.
Sure.
It's really good in that sense that, like I said, if you're having issues getting credit or the financing means of getting a mortgage are just not in your favor in this case, then maybe this is the way to go.
True.
However, there's some downsides to this. The first thing is it's extremely risky as a seller in this case, because if the buyer doesn't make the payment or defaults in this case, they can be legally liable to make the payments.
Oh, okay. Whoa.
So it can be very, very difficult, and it's very risky as a seller in that sense. So I would try and build a relationship with that person as quick as possible, so they feel obligated to make the payments.
Yeah, true.
Or if you're a buyer, try and build up that relationship with them, so you're not having to worry about. Not have to worry, but just be able to be offered that option as well.
Well, and for the seller side, financing is something yourself might not seem like a great idea.
Yeah.
But you can actually net more money for tax purposes.
Yes.
For example, if you buy a $400,000 house and you sell it at $600,000, you made capital gains, let's say, of $200,000. You're going to pay taxes on that $200,000.
Yep.
Whereas if you're making, if you're slowly making, 15, 20 grand a year, you're not going to pay as much taxes as if you're making 200 grand in that year, Yeah,
that's a good point. Yeah.
So that's how long-term, financing over the long term, it could be beneficial for the seller.
Yeah. The last thing I got to go and add for the seller/owner financing is some downsides to it as a buyer. Although there is, like I said, lower down payments typically, and it does not really have closing costs since it's automatically straight buyer to seller.
Mm-hmm.
You will typically have higher interest rates for this. And you can also deal with due on sale, what they call due on sale clauses.
What's that?
And this is and this is where the seller has a mortgage that they have to pay off in this case. And if they have to go and make those payments, if they still have a mortgage, the buyer can be obligated to go and pay off that mortgage.
Whoa. Okay, interesting.
Yeah.
So that's if the bank decides to use their right to collect immediately?
Yes. So basically what it means is if you don't have, if the seller financing is done and you own the house and you figure out that there's still a mortgage on it because technically it's from buyer to seller, the seller can do whatever they want with that money. And if they still had another 5 years or something like that and it was not disclosed, you may be obligated to purchase the home and pay off that mortgage.
And that's why, as you said earlier, due diligence is so important, which includes lien insurance or title insurance, just to make sure that there are no debts. And it won't just be a mortgage. It could be unpaid repairs, that there's been a lien associated to it,
Yep.
There's all sorts of ways that you can lose if you don't do your due diligence.
Well, it's so important. But in this case, it's why you have to go and have an agreed price and have the paperwork in place, whether it be have an appraisal done at the start of it to have that or have an appraisal due midway through. It's really important to do your due diligence, like you said.
Yeah.
Now, our third form, this one's kind of fun, and I call it crowdfunding or co-buying.
Okay, this one's interesting. Tell me more exactly how it works.
So basically what crowdfunding is basically getting investors to go and pay for the home itself or the property. I'm saying home, but if you're into real estate or anything like that, you're more than likely either doing a flip or you're going to rent.
Sure. Makes sense.
Property. And in this case scenario, for co-buying, is basically grabbing a bunch of friends or people that you trust and purchasing a property together.
Yeah.
And it's pretty cool, but it can be a form. It can be a really big positive if you have a strong team. So let's say you have a good team of guys who have really good financing, or they have a really good credit score. So let's say you're 4 of you. It's like, you know what? Let's go and buy ourselves a $1.2 million property. You can
leverage it to that. Yeah, you're right.
You could, if you have good finances, you're able to go and get the down for something like that. Imagine the type of property you can get for $1.2 million in Northern Ontario. Not Toronto. You're just basically getting a home. But you can get yourself quite the property for $1.2 million around here. And
no doubt.
You can get I've literally seen 18 or 20 room apartment buildings going for around that here.
Woo! 18 to 20 rooms. That's a good deal.
It's like 1.5, if I'm not mistaken. But
interesting.
I'm sure there's renovations that have to be done and stuff like that.
Yes, of course.
But even then, though, if you have a group of people who are able to do so, then that's all the power to you. You have a carpenter on your team. Could you imagine? Or you have some handyman. You're saving yourself a lot of money in that case. Or you have some driven people who are willing to get down and dirty in that case.
And sometimes, if you have expertise, it could actually be a replacement for actually putting money down.
Yes.
So let's say if you are a carpenter, or if you're an electrician and it needs a lot of electrician work, then that could be one of your contributions. You say, look, I'm not going to pay the same amount as you guys. I'm going to be doing a lot of work here that's worth a lot of money. And you can actually work that out with your friends. Just have an honest conversation and try to be fair, and you can usually work it out.
Yeah, exactly. And the important thing for this kind of stuff is that you break it down. So exactly like you were saying, talk it out, but write it down, but have the financing, the paperwork, the layout of the ownership percentage. Because if you just go and say, let's say you're 4 you and you say 25% across the board and it's just verbally done, and then you have a guy who does nothing the entire time versus the 3 others who are busting their ass, sorry for the term, but while doing all the renovations, while he gets to reap the rewards. Well, I really hope that person who's not putting any of the work put in 75% of the down payment for this.
Yeah, exactly.
To contribute in that way.
Or is at least financing the renovations or things like that, right?
Or better yet, if you don't have any verbal agreement, then, or not any written agreement, could you imagine how bad it's going to get when you don't have any information? Like, who's going to get the income, and what if it goes into what account and everyone but this one person gets it, and it turns into a whole. You're putting your friendships on the line as well because of business. It's true. It's a huge risk. Business and friendship are 2 things that typically should be put aside.
It's true. You better make sure that you have a strong foundation if you're going to build something there.
Exactly.
And I have a con for this one that I'd like to add.
All right, please do.
One of the cons is I'll say it as a crowdfunding aspect.
Okay.
Let's say you have 50 people investing, and everyone's pitching in a little bit, just to be able to make ends meet. You buy the property.
Yep.
10 people want to sell, but 40 don't.
Mm-hmm.
Which means 80% don't want to sell, 20% do want to sell, assuming it's split evenly. What's going to happen? You can maybe try selling it to a person who's interested in holding that value that you have, but the value is going to be hard to estimate. If everything goes south, liquidating that asset is very difficult, unless the bulk agree to sell.
And also, I guess you could pay out in that sense, but again, you could pay them out. Like, those investors can go and pay off those 10 remaining who don't want to sell. But then
again, they have to agree to a payout, to a valuation.
Yes.
And some people don't want to inject any more money into it, saying, I'm actually perfectly happy with my 2%. I don't want any more. So it's a risk.
It is very much a risk, but it's a reality of facing when you're dealing with people. That's why some people just want to get into real estate alone or as a couple, because there's too many hands in the cookie jar. Sometimes it's not good.
Or 51% ownership.
Yes. Yeah, exactly. And our last form of financing, this is our fourth segment. This one's a fun one, and it's buying a home at an auction.
Oh, okay. All right.
And buying a home at an auction is very interesting because it's not your typical means of purchasing a home, obviously,
right.
Especially here in Canada. I've actually saw a report by, I think it was CBC, that had looked at Australia and how they do things, and all their housing is done through auctions.
Really?
Yeah, everything is auctions. But you think about it, look at Toronto and Vancouver, all of it is bidding wars.
Fair. Yeah, fair. Yeah, maybe we are slowly turning into that.
Well, that's exactly it. And I don't know, I have to look at the news. I don't know if it was BC or if it was Canada-wide.
Yeah.
But they started, I'll say BC just for the time being, revealed that they're offering the option for people to look at bids. So when there's a bid in place, there is nothing hidden. And it's full transparency.
Oh my goodness.
And it's twofold in that sense because it's like, okay, it can increase the amount of bids and inflate the price of the home.
Yeah.
However, you can get people who shy away.
Scare people away. Yeah.
Exactly. So
let's say there's 5 days left in the auction, and you saw the first day that there was 18 bids. You say, okay, well, it's probably going to go to this much. I can't afford that. I'm not even going to participate.
Well, that's it. So the biggest thing for this kind of stuff is to just be able to go and get your emotions in check.
Mm-hmm. Yeah.
Be able to have your plan in place. Don't get too distracted or attached to the building itself. And I mean, we've said it in prior episodes. This is our max cut, so we're not going to spend more than $400,000. Or if you're in Toronto, we're not going to spend more than $700,000 on a property. And
sometimes it makes you wonder how people can even afford to live in Toronto. No.
Well, that's the whole reason why it takes like 20 years to get a down payment in Toronto.
That is so crazy, man. So crazy. And then how many people have income that justify that big of a loan? It's so crazy to me, man.
And that's exactly it. But one thing you also need to know is the type of auction you're facing with.
Yeah.
There are two different types of auctions that you can be faced with. The first one is called a lender confirmation. And they're typically done with banks or with the government, government properties, where the lender doesn't have to accept the offer.
Interesting.
The winning bid, I should say.
Yeah.
And
so it's a way to not have to establish a reserve, I guess.
Well, that's just it. But the funny thing is you can have a reserve in specific type of properties, or like an absolute auction can have a reserve.
True.
And you won't have, like you said, we won't have typically a reserve for lender confirmation, but you will have you can have a reserve for an absolute auction. And the absolute auction is that the seller has to accept the winning bid.
Interesting. So you have no say.
Yeah. Well, if you have a reserve and it's not met, then you technically do have a say. But if it is met, let's say you're saying no more than 400,000. Like I want at least 400,000. But in the back of your mind, you're like, I kind of want like 475, 500,000 for the property.
Yeah,
It sells at 405, and you're upset. Well, I hate to break it to you.
Those are the terms. Should have put a higher reserve. Yeah,
that's it. So, it's absolute in that case.
Yeah.
Other things that you need to consider when you're buying a home at an auction is you have to pay attention to, I always have liens,
Yes.
claims, and if there's occupants in the property itself.
Oh man, that's a frustrating one, especially in Quebec, where sometimes it can be a lot harder to evict someone.
Oh, well, exactly. You have properties that are, or not properties, but states that are more in favor of the renter, and then some that are more landlord friendly.
Yeah.
Because you get bad apples on both sides too.
It's true. There's bad landlords as well. And things like rent evictions, where they're forced. Well, part of it is unethical, and part of it is, well, the laws are so strenuous that we have to do it this way. You know.
Yeah, you see both sides. And the last thing I got to add to buying a home at an auction,
Mm-hmm.
and I mean, we're getting flashbacks to COVID 2020, 2021, and it's the fact that everything is done so quick.
Yeah.
That you may be faced with problems that you do not see when you walked in. So,
and that's part of due diligence too, is a home inspection, right?
Yes. And that's exactly what ends up happening. And I'm saying 2020, 2021, where people were literally doing bidding wars, and you didn't have the time to do an inspection, which, thank Lord, they're slowly starting to come back into style again. Like the most ridiculous thing, no inspections, no nothing, hands down over asking, and that's what we're doing. And so in this case here at an auction, if you don't have an inspector with you alongside you for a property that you're interested in, or you don't have the skill sets for it, you're walking into some risks right there, because you're basically buying the property as is at that point.
Yeah, and that could be a world of trouble. Unless if you put a due diligence clause inside your purchase offer.
Yes.
Which you can do.
You can do. That's a good case. So those are awesome ways to avoid that kind of stuff, bad problems.
Yeah.
But there are also these are 4 different ways that you can go and actually purchase a property without actually having a mortgage.
Very, very nice. Very informational.
That's what I liked about it. I wanted to do that.
Yeah, and you never hear of these options either. So it truly is creative ways to finance your purchases. I'm really happy with this.
I know actually some of our classmates in university, I think they were a group of 3 or 4 guys. I mean, I guess it kind of shows that they came from a little bit of money, because all 4 of them purchased a home and flipped it.
Yeah.
They made a really good return on it, which I thought was absolutely really cool. Imagine doing that in the middle of university.
Yeah.
So, but that's a form of crowdfunding right there.
Exactly,
Co-buying.
and it worked out. Yeah,
it worked out well.
Yeah.
So with that being said, this is episode 129, How to Finance Real Estate Without a Mortgage. Interesting stuff there.
Honestly, and I every time there's a real estate episode, we could just go on.
So with that being said, my name is Owen Paradis. I'm here with my co-host William Goulet, and we're proud to present to you the College of Wealth podcast. Peace.
2 figures, peace.
This has been your daily dose of motivation with the College of Wealth podcast. If you enjoyed the show, make sure to leave us a positive review on Apple Podcasts and Spotify. It would be greatly appreciated. Thank you for listening, and until next episode.